Welcome to our video. Mutual funds pool money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other securities.
Managed by professional fund managers, they offer diversification, reducing risk while providing access to a wide range of investment opportunities. Ideal for those seeking a balanced approach to investing without the need for extensive market knowledge. Mutual funds are investment vehicles pooling money from numerous investors to purchase a diversified portfolio of stocks, bonds, or other securities. Managed by professional fund managers, they offer investors access to a broad range of assets, reducing risk through diversification. Each investor owns shares representing a portion of the fund's holdings. Mutual funds are Securities and Exchange Commission registered open-end investment companies pooling money from thousands of investors to enhance buying power. They invest in diversified holdings like stocks, bonds, and money market instruments. Each share signifies proportional ownership of the fund's portfolio, which is professionally managed for optimal performance. Pooling resources allows individual investors to access professional management and diversified portfolios. This collective approach enhances buying power, enabling investments in a wide range of assets. Such diversification reduces risk and increases potential returns, offering a strategic advantage that individual investors might struggle to achieve independently. Mutual funds offer expert management by Securities and Exchange Commission registered advisors with deep market expertise. They provide instant diversification, spreading risk across various securities and industries. Accessibility is key, with low minimum investments and daily liquidity, making professional management available to all investors. Mutual funds pool money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other securities. Each investor owns shares representing a portion of the fund's holdings. Professional fund managers make strategic decisions to align with the fund's objectives, aiming to maximize returns while managing risk. Investors purchase mutual fund shares at the net asset value, determined daily post-market close. Fund managers actively trade securities to align with objectives and enhance performance. Investor returns are generated through dividends, capital gains distributions, and net asset value appreciation, which mirrors the portfolio's growth. Mutual funds offer three primary ways to earn money: dividend income from stocks and bonds, typically distributed quarterly; capital gains from selling appreciated securities, usually distributed annually; and net asset value growth, where your investment appreciates as the portfolio value increases, minus operating expenses. Mutual funds come in various types, each catering to different investment goals. Equity funds focus on stocks for growth, bond funds invest in fixed income securities for stability, and balanced funds combine both for diversification. Money market funds offer liquidity with low risk, while sector funds target specific industries for concentrated exposure. Equity funds offer growth and income potential through diverse strategies. Investors can choose United States domestic or international funds for global exposure and currency diversification. Management styles vary between actively managed funds and index funds, tracking benchmarks like the S&P 500. Strategies include growth funds, dividend income funds, and market capitalization focuses such as small cap or large cap. Fixed income funds emphasize stability and income through investments in government and corporate bonds. These funds offer predictable income streams and steady returns, making them less volatile than equity funds. Ideal for investors seeking regular income with reduced risk exposure, they provide a reliable alternative to stock-focused investments. Balanced funds offer a strategic mix of stocks and bonds, providing growth and income in one fund. They feature automatic rebalancing and professional management, ideal for moderate risk tolerance. Specialty funds focus on specific sectors like technology and healthcare, or themes like environmental, social, and governance, offering targeted exposure to emerging markets and regions. Understanding mutual fund costs is crucial for maximizing investment returns. The operating expense ratio, OER, is an annual percentage covering management fees, administrative costs, and operational expenses, directly reducing returns. Load fees are one-time sales commissions, either upfront or upon selling shares. Transaction fees are additional charges imposed by some brokers for buying or selling certain mutual fund shares. The operating expense ratio, OER, is an annual percentage that covers management fees, administrative costs, and operational expenses, directly reducing your returns. Load fees are one-time sales commissions, either upfront or upon selling shares. Transaction fees are additional charges by brokers for buying or selling certain mutual fund shares, separate from fund expenses. The industry average expense ratio is 0.51%, while Vanguard's is just 0.08%. This small difference compounds significantly over time, impacting your returns. High-cost funds need to consistently outperform low-cost options to justify their expenses. Understanding these nuances is crucial for making informed investment decisions. Investing inherently involves balancing potential returns with associated risks. Higher returns often come with increased risk, requiring careful evaluation. Understanding this trade-off is crucial for informed decision-making, as it helps investors align their risk tolerance with their financial goals. Mutual funds lack Federal Deposit Insurance Corporation insurance, exposing investors to potential principal loss in declining markets. Their performance is tied to market volatility, leading to significant fluctuations. Generally, funds offering higher returns come with increased risk and volatility, emphasizing the importance of understanding the risk-return relationship when investing. Mutual funds offer professional expertise, providing access to full-time investment professionals with extensive research resources. Diversification across multiple holdings reduces risk compared to individual stocks or bonds. Additionally, small investors benefit from access to broad markets, international investments, and institutional quality management, enhancing their investment opportunities. Mutual funds trade once daily at net asset value after market close, while exchange-traded funds trade continuously like stocks. Mutual funds have expense ratios typically between 0.3% and 1.5% annually, whereas exchange-traded funds often range from 0.03% to 0.75%. Mutual funds require direct purchase from the fund company, while exchange-traded funds need a brokerage account. Mutual funds trade once daily at net asset value, while exchange-traded funds trade continuously like stocks. Mutual funds have higher expense ratios, typically 0.3% to 1.5%, compared to exchange-traded funds 0.03% to 0.75%. Mutual funds require direct purchase, often with $1,000 to $3,000 minimums, whereas exchange-traded funds need a brokerage account but have no minimums. Investing in mutual funds is accessible and straightforward. We'll explore key differences between mutual funds and exchange-traded funds and guide you through the steps to start investing, including checking employer plans, opening an investment account, researching options, and reviewing documentation. Begin by reviewing your employer's retirement plans for mutual fund options and potential matching. If investing independently, select a reputable brokerage and open an account. Use online tools to screen funds that align with your risk tolerance and goals. Finally, read the fund prospectus to understand fees and strategies before investing. Evaluate mutual fund performance over 3 to 5 years to avoid short-term market noise. Compare expense ratios and fees, as small differences can compound over time. Diversify across fund types and asset classes to mitigate risk. Reinvest dividends and capital gains automatically to leverage compounding growth. AI and machine learning are revolutionizing portfolio management, optimizing risk assessment, and refining investment decisions. ESG-focused funds are gaining traction, drawing significant investor interest. Mutual funds continue to dominate retirement investing, showing robust growth in 401k plans and individual retirement accounts, underscoring their enduring appeal and adaptability in evolving financial landscapes. Mutual funds offer professional management and diversification, accessible with modest investments. By understanding fees, risks, and fund types, you can align choices with financial goals. Starting early and leveraging compound growth systematically builds long-term wealth. Make mutual funds a cornerstone of your financial independence journey.